In the alternate version of problem 4.3, we're initially introduced with an adjusted trial balance for Valley Company and asked to produce an income statement. To this point, we've been familiar with what's called a single-step income statement. Take all our revenues, like our sales here and our contra revenue accounts, subtotal them, and from that subtract out all of our expenses in one lump sum total or single step in order to arrive at net income. In this chapter, we introduce the concept of the multi-step income statement. Now we're going to take those same revenues and expenses that we would have included in our single step income statement, but as you see here, we're going to subdivide them into different categories or subtotals. So we've got multiple steps within this process in order to provide additional detail than that simple listing of revenues and expenses that would have been provided in a single step income statement. So it just gives us more detail and understanding of the company. The good news is we start out the exact same way with net sales, whether it's multi-step or single step. So we start out the same way. So we're going to start out with our gross sales of $294,120, but we have to subtract out any sales discounts, which are $4,500 in this situation, and any sales returns and allowances, because these are contra revenue accounts, of $19,412. The combination of the sales discounts and sales returns and allowances is $23,912. If we subtract that from our gross sales of $294,120, we arrive at net sales of $270,208. So again, start out the exact same way that it would do with a single step. But this is where things change. Again, instead of subtracting out all our expenses as one subtotal, we're initially going to subtract out only one expense called cost of goods sold in order to arrive at gross profit, or often called gross margin. Now, in this situation, we've been provided the total of cost of goods sold being $113,298 because we use a perpetual inventory system. And so we keep our expense account up to date. As we're selling goods, we take out the cost from our inventory balance on our balance sheet, and it shows up in an expense on our income statement. If we use a periodic inventory system, we would not necessarily keep a running total, but again, perpetual will keep a running total. I do, however, want to review how could we come up with this cost of goods sold amount based on knowing some additional information like our ending merchandise inventory amount, our beginning amount that were provided, and some supplemental information about our purchases. I want to prove out that we can come up to that total because while not a requirement of this problem, it may be a concept that you have to know for other problems. So let's go back to a formula that I included on our initial exercise and discussed early on in your chapter. The fact that beginning inventory plus the cost of our net purchases of inventory, which would be goods available for sale. So what I started with plus what I purchased would be available for sale. That has to equal the combination of the cost in ending inventory plus the cost of goods sold. Think about this. What I have available for sale is either going to be on hand in ending inventory or it's going to be sold and become part of the expense cost of goods sold. You also recall I used a little algebra to move some of these items around. In fact, I subtracted ending inventory from both sides to prove out the beginning inventory plus net purchases minus ending inventory. So what I have available, if I subtract out what I'm left with at the end of the period, I can come up with cost of goods sold. In this scenario, I know beginning inventory. I'm given it that's $34,701. I know ending inventory. It's already in my adjusted trial balance of $43,000. But on the other hand, I'm not directly given net purchases here. That's not going to be something that's directly listed in my adjusted trial balance, but I can use information, supplemental information that was provided about various purchase amounts in order to arrive at net purchases. So let's work through this. I can take the cost that I'm given down here that I was charged by my vendors for my merchandise inventory of $126,420, but I need to subtract out a couple of things because I was offered purchase discount for prompt payment. We took $2,655 worth of purchases discount, so I need to subtract that from my purchases. I also need to subtract out $6,068 of purchases returned to allowances, because those are things I either return to my vendors or they give me a concession on the pricing because maybe I was unhappy with them. But I also have to add in any cost of transportation in. So if goods were shipped FOB shipping point and there's any freight charges, I need to include that in or add that $3,900 in to my overall cost of purchase. So 126,420 minus 2,655 minus 6,068 plus 3,900 equals an overall net purchase cost of 121,597. Now I have all the figures on my left in my formula to make sure I arrive at the same cost of goods sold. So beginning inventory of $34,701 plus the total net cost of purchases that I just calculated of 121,597 equals total goods available for sale of 156,298. Just like I subtract out here, if I take out or subtract out ending inventory of 43,000 from that 156,298, I magically arrive at my same cost of goods sold total of 113,298. So it's good all the information from my records ends up agreeing. So jumping back into this particular problem and moving forward, again, I started with net sales of 270,208. I take my cost of goods sold that I either calculated or pulled from my adjusted trial balance of 113,298, and I arrive at a gross margin or gross profit of 156,910. Now again, this is a new calculation to the multi-step. In fact, on the single step income statement, gross profit or gross margin doesn't exist. So a good sign as to whether a particular income statement is multi-step or single step is whether or not you see gross margin or gross profit. If you see it, it has to be a multi-step income statement. So that's a good hint there. Reason why I calculate this is I want to have an understanding of all my sales dollars, what's left over after I subtract out the cost related to those items that I had purchased and sold to my customers. What's left over to cover all the other expenses of the business? Because beyond what it costs to provide that particular product, there's going to be other stuff. There's going to be sales staff, there's going to be my accounting group, HR, legal, different parts of the business. But this gives me a subtotal of what's left over in order to cover all those additional expenses. I also mentioned, while not a required part of this problem, but a concept discussed in your book is the gross margin ratio, also called the gross profit ratio. You would take the gross margin, in this instance it would be 156,910, divided by net sales, which here is 270,208, and arrive at a percentage of 58.1%. So it gives me some sense again of my sales dollars, what's left over in order to cover all my other expenses. So 58.1% is left over, or I can think of it another way, out of every dollar of sales, about 58 cents is left over to cover the other expenses of my company. So let's continue to move forward building our multi-step income statement. Now, I mentioned expenses are included in different categories. So we're going to next subtract out what we call operating expenses. So beyond the expense of the cost of the product, what are all the other regular day-to-day things, expenses that happen with a business? We're going to subdivide them into two separate categories. One is selling expenses, the other is general and administrative expenses. Like discussed in the book, selling expenses include any expenses related to promoting and advertising the product. So what does it take to advertise and market the product to our customers? It might take a sales group, so their salaries, any depreciation related to vehicles they may drive to visit customers. It may be billboards or advertising. what it takes to actually make that sale. So again, does it take sales staff and their salaries in order to actually execute that sale? Do we have cash registers, depreciation or rental fees on those particular cash registers? Another major category of selling expenses is delivery expenses. So maybe we have a fleet of our own delivery vehicles, depreciation on those delivery vehicles. So what does it take to promote or advertise that sale, to actually make the sale and deliver that particular product to the customer? If we look at our listing of various expenses, the items that fall within there are salaries, sales salaries expense of $40,294, rent expense of our selling space. It's got to be particular to our selling space of $13,824. Various store supplies expenses of $3,529, and also advertising expense of $25,000. If we add the four of those up, we get total selling expenses of $82,647. Now we're not finished. Our next category is going to be general and administrative expenses. It's sort of a bit of a lump sum category of expenses. It's what are all the other normal day-to-day expenses that a business has to support its overall operations outside of the cost of the product, cost of goods sold, and selling expenses. So what other expenses exist to support overall operations? And it can include things like accounting, human resources, financial management, overall IT resources, the legal department, any expenses related to those particular areas that support the overall operations are lumped into general administrative expenses, sometimes abbreviated as G&A expenses. So if we look over here, our general administrative are going to include office salaries expense. So maybe perhaps we have a receptionist. Wouldn't be the only category in here that just generally supports the overall operations, greets people when they walk in the door, answers the phone. So we've got office salaries expense of $36,765. You see rent expense again. It can be included in multiple categories, but this time it talks about our office space, not our selling space. So rent expense of $3,529. Also, we have additional supplies, just like we had store supplies, but now we have office supplies. Expense of $1,176. Adding the three of these up, we get total general and administrative expenses of $41,470. Now I'm going to add up my two categories of operating expenses. Again, all the other normal day-to-day stuff outside of the cost of goods sold. So total selling expenses of $82,647 plus total general administrative expenses of $41,470 gives us total operating expenses of $124,117. If I move on to my last step for this particular company, I would take my overall gross profit of $156,910. Remember, I took net sales, already subtracted out cost of goods sold. Now I subtract out all my operating expenses of $124,117 and arrive at a net income of $32,793. Now, single step starts in the same point with net sales, ends at the same point. So single step and multi-step are going to start out with net sales and end up with the same net income number of $32,793. But there's going to be different categories within our multi-step versus our single step. I will also notate that for some companies, or not just some, but many companies, instead of calling this net income right here, it would actually be called income from operations. And I'll explain that a little bit. If we take gross profit and subtract out operating expenses, for most companies, we arrive at what's called a subtotal called income from operations. For many companies, we have a category of what we call other revenues and gains or other expenses and losses. So they might have revenues or expenses unrelated to normal day-to-day stuff. For example, they might have an investment maybe in another company, own stock in another company, and get dividend income from that. Well, if they're not in the business to make investments in other companies and they're just doing that because they've got some idle cash and want to earn a little bit of dividend income from that, it's not part of their normal operations, so it's not going to be lumped into sales. It would fall within the other category. Also, if a company borrows funds, maybe goes to the bank and borrows funds, has to pay interest expense on that. The expectation is the bank's not going to just give it to you for free. They have an expectation of interest. Again, borrowing funds isn't a normal thing you go out and do every day. I mean, making sales, purchasing product related to that sales, having a sales staff, having an accounting group, having an HR group, those are normal day-to-day things. Borrowing money isn't necessarily a normal day-to-day thing, so interest expense would fall within this category. Also, let's say we had a delivery vehicle and we went and sold that vehicle. We want to upgrade. Any gain or loss that we made on that vehicle when we compare what cash we got from it to what we had on our books wouldn't be a normal day-to-day thing if you're not in the business of selling vehicles, so it would fall within this other revenues and gains. If we had been a company that had some of these other things, we would have had to take income from operations and either add the overall inflow or revenues or subtract out any overall expense and loss in order to arrive at net income. We didn't have that, so instead of this figure being income from operations, we just went ahead and listed it as net income.